We are on track for our fourth straight week of declines. We have entered a technical correction.
Down 27%. It is the worst day in 50 years.
I think we're going to see the S&P go down 86% from the top and the NASDAQ 92%.
Wall Street is bleeding. There was a mass sell-off on Wednesday. Investors lost as much as $1 trillion. $1 trillion in a day.
I really think we're going into a deflationary period, and most people have never seen that. It really hasn't existed since the Great Depression. We are not contrarian just to be contrarian.
Yeah.
You asked what's so contrarian? That we buy stocks when they've dropped 30%. This is going to be a very volatile part of your portfolio, and some people have understood that, and other people have not understood that. If you're going to ask me at one point in this, is there anything you would leave us with? If you fight, you're probably going to lose.
All right, Cathie Wood, thank you so much for coming on the Iced Coffee Hour. It is an honor.
It is.
Oh, thank you. Thank you, Jack and Graham. I'm delighted to be here.
So the first question is, you seem like a very busy woman. How many ETFs do you manage?
We just launched in Europe with 3, and then 8 here. And then we also sub-advise for mutual funds in Japan. Mm-hmm. So that may be some of what you're seeing. There are a number of mutual funds there.
And what's the assets under management currently?
So we're approaching $25 billion. That includes the Bitcoin ETF.
Yeah. Why should people listen to you?
I've been in the business for more than 40 years. I've seen lots of cycles. You may be asking that now because for a couple of reasons. In 2020, as we really boomed during COVID, we could do nothing wrong. And everything we said, people, were clinging to, although they did not cling to something that I did say at that time, which was keep some powder dry, because I knew that boom was unsustainable. So now, 3 years later, we've been on the down cycle. We went 2 years down. We had another nice burst in 2023, and this year has been a little bit challenging. So I have been through a lot of cycles, and truth wins out. If it's on the topic of innovation and investing in innovation, I've been managing money since 1990. As the world went into the tech and telecom, what became the bubble, and I also saw the bust. And so I have a frame of reference, and it is this, that the seeds for everything that we are doing now in terms of investing in innovation, those seeds, those technologies, seeds were planted in the 20 years that ended in the tech and telecom bubble, and they've been germinating for the past 20, 25 years. We've been monitoring them. We are ready for prime time. I think the biggest surprise to me, and maybe one of the biggest reasons your listeners might find this interesting, is the tech and telecom bubble. You had investors just throwing money at dreams. Those were just seeds, dreams. Today is the reality. Those seeds have germinated and they are blossoming now. And yet investors are scared to death. They are investing in very few stocks. You've heard about the magnificent, used to be 7, then they threw Tesla out, and then it was 6, and then it was 1, NVIDIA. We know that a very concentrated market like that is either very, very good in terms of what it says about the future, or very, very bad. And we can show you a chart, you can post it, showing that the concentration that we have just seen in the Mag 6 is higher than it has ever been in history, going back to the Great Depression. Great Depression in the 1920s and early 1930s, we saw similar concentration. Why was that? Cash was king, just like cash in the Mag 6 is king. But back then, cash was king because the unemployment rate soared to 25%. Now we're at 4.1%. Real GDP dropped 30%. Real GDP is still growing, maybe more slowly, 1.5%, but growing. And prices were deflating 25 to 30%. So the reason for the concentration in the Great Depression, which, again, we're higher concentrated now, was because the situation was binary. Is this company going bankrupt or not? And it was also during a time of great innovation. Telephone, electricity, and internal combustion engine completely changed the world. So what was the number one stock back then? The equivalent of NVIDIA today? It was AT&T. Telephone. It was just proliferating throughout the world. So what does that tell us? How does that inform us about today? If you look at what happened after the peak in that concentration back then, the market broadened out. It started rewarding more companies than just the few being rewarded at peak concentration. And we actually think that's what's going to happen now, that this period of concentration towards the Mag 6 has been a function of two things. One, fear. Interest rates soared 22-fold in little more than a year's time, and we're still seeing the fallout, especially in real estate, but now in other sectors. That shock led to this desire for cash. And if people were going to dabble in the equity markets, they moved towards the high cash oriented stocks and those that might be helped by this thing called artificial intelligence, just like AT&T was helped by this thing called the telephone back in the Depression. Yeah. Now I think we're going to broaden out, which will reward our strategies, we think, dramatically, because we are not in the mega caps.
Let me ask you this. How did you get started with investing? Like what piqued this interest?
I was in college. I was 20 years old. I met, and one of my professors was Art Laffer. Art Laffer, I don't know if that name means anything. Probably not. It's in economic circles, it's called the Laffer curve, and it has to do with taxes, and we can get into that if you'd like. But I met him. I was taking his courses at the University of Southern California, and I was so enthusiastic about what he was teaching. And I just wanted to gobble it all up. I was passionate. He struck a responsive chord. And he knew that a company, Capital Group, downtown LA, was looking for a person to come in and do kind of statistical work, grunt work, I would say. And so that's how I got introduced to this world. And I was supposed to do the grunt work, and I did do it, but the person I was replacing, they were going to bring in 1.5 people. I was the half. And I said to myself back then, I am not going to be the half. I want this job. I want the whole thing. And so I was going to school full-time, working full-time. But the first project they put me on was Hong Kong 1997. That just gives you a sense of how long-term oriented. I was in college in the late 70s, so 1977. And my first project was 1997. Capital Group, premier research firm, investment firm. And I said, wow, they're paying us to learn. I love this. The world is our oyster. We get to learn about what the world's going to be like in 20 years. And so that started my love affair with the business, I would say, and the 80s and the 90s. So those were the first 2 decades, real decades of my investment career. They were It was really active management coming into focus and style. And it was, an incredible time.
What were the predictions for 1997?
Well, 1997, and I realize this 1997 seems like it's coming out of the blue. That was when England was going to turn Hong Kong over to the Chinese. So, and it was called Two Countries, One System, something like that. And so we were trying to understand how would that change investing in globally.
Mm-hmm.
And so that's why the specific year. So
How close was your prediction or like what you were researching to what actually happened in 1997? Do you remember?
We thought it was what was going to happen was that China was going to flourish. I mean, Hong Kong was going to flourish. It already was flourishing. It was sort of the financial center of Asia at the time. But the question was, would China, bringing China into the equation, cause a boom? And our prediction was yes, that it would. And that is what happened. And in fact, what we didn't predict, though, was that the World Trade Organization would invite China in the very early 2000s, and that would reinforce the financial boom and, bring us almost 20 years of really Asia flourishing. And Capital Group at the time, in the 70s, was one of the very few American managers who thought anything outside the U.S. was interesting. We were very myopic, the business was back then, and Capital was very adventurous. Really, I think one of the first firms to set up offices in Switzerland and in Tokyo, Hong Kong. So it was a great call for Capital Group.
But before we get into that, as you can tell from this episode with Cathie, AI might just be the most important new computer technology out there. It's storming every industry and literally billions of dollars are being invested, so buckle up.
The problem, however, is that AI needs a lot of speed and processing power. So how do you compete without your costs spiraling out of control? Well, that's why it's time to upgrade to the next generation of the cloud, Oracle Cloud Infrastructure, or our sponsor, OCI. For those unaware, OCI is a single platform for your infrastructure, database, application development, and AI needs. OCI also has 4 to 8 times the bandwidth of other clouds, offers one consistent price instead of variable regional pricing, and of course, nobody does it better than Oracle. So now you can train your AI models at twice the speed and at less than half the cost of other clouds.
So if you want to do more and spend less like Uber, 8x8, and Databricks Mosaic, take a free test drive of OCI at oracle.com/iced. Once again, guys, you can try it completely for free at oracle.com/iced, oracle.com/iced. Thank you so much, Oracle, and back to the podcast.
Now, I've noticed when we were researching you, some of your most popular topics and videos were on Bitcoin.
Yes.
And I'm curious, when did you first hear about Bitcoin?
2011, Brett Winton, who's our chief futurist at ARK now, but who was the senior analyst on our research on strategic change at my prior firm. He came in, he had read an article. I don't know if it was might have been in The Economist. And he started talking about Bitcoin and crypto generally. And we were like, what? And so that happened one day. But then he became fixated on it and we had a brainstorm every Friday. And every Friday, there would be a new story about Bitcoin. Now, it was so young back then, right?
This is back when it was about $1.
Yes.
Right? Yeah.
Yes. And there was no way to play it. And so we were thematic. So we were looking at it and trying to understand it and trying to figure out, is there anything here? This is a technology, yes, but it's also a monetary system. Could this play the 3 roles of money? And so, it was an interesting topic. When we started ARK, the 2 things we lumped back then, so this was 2014, were artificial intelligence and blockchain technology. But we lumped them into next-gen internet because they were both, even though AI has been around since the 50s, The very big breakthrough, the provocative breakthrough, was as a result of ImageNet and deep learning in 2012. So we were trying to figure out, is this important? Will this move the field of AI forward so that we'll have meaningful investments? So as I would say within the first 2 years, we separated next generation internet into artificial intelligence and blockchain technology. So they became 2 of 5 innovation platforms. The other 3 are robotics, energy storage, and multiomics sequencing. These are the 5 major platforms that are evolving today, sort of like telephone, electricity, and internal combustion engine. Those were multiple platforms evolving at the same time about 100 years ago. Now we have 5 evolving. And again, this is unprecedented and, just pretty exciting. So Bitcoin was back then, 2011, and our first investment, and this was, we had to ask permission from the New York Stock Exchange. Can we put it in an ETF? And they said, yes, you can put this GBTC into your fund, but only 1%. And we said, great. They didn't say that it couldn't rise from 1%. And so we let it rise. And of course, so it moved from $250 when we got in September of 2015. So toward the end of 2017, I think it hit $20,000. So swoosh.
Yeah. What does Bitcoin solve?
It solves a lot of things. To us, Bitcoin means 3 things. 1, it's a new technology. Blockchain technology is a new technology. But to simplify it, all we're doing here is layering into the internet the layer that developers forgot to build in the early 90s because no one understood that financial services or commerce would take place on the internet. So I was there, and I remember agreeing with everybody, I will never put my credit card on the internet. This is not secure, right? And so they never built it in. So blockchain technologies of all types are an answer to that. This is peer-to-peer technology, taking a lot of middlemen out of traditional financial services, taking layers of fees out. And those fees are anywhere from 2.5% to 4% of any given transaction. That's the first thing, a technology. The second is it's a monetary system. So, and each one of these words is important. It's the first, global, private, meaning no government oversight, digital, decentralized, rules-based monetary system in history. It is a very big idea, and my former professor, now friend, Art Laffer, couldn't be more excited. He's about to turn 84, and this has rejuvenated him. Because he says, this is an opportunity to go back to the U.S. pre-Fed, so pre-1913, when we were basically using private money. So it will give the dollar a run for its money, so to speak.
Yeah. Why do you think that older people are less receptive to Bitcoin, like Warren Buffett or Charlie Munger, so against it? And it seems like young people love it.
Yeah.
Anyone over the age of 50, for the most part, either they don't know about it or they're very skeptical. Why do you think that is?
I think partly it's technology, that there's discomfort. Warren Buffett famously has said, if I don't understand it, and I don't understand most technology, I'm not going to invest in it. Now, he did invest in IBM, kind of at the wrong time. So that proved, to reinforce what he was saying. However, he didn't give up. He did invest in Apple, and that's been, a grand slam for him. So, but very little interest in technology, and a lot of people pay attention to him, especially more value-oriented investors, where, in technology, you've got very often you have to invest aggressively. A company has to invest aggressively in the short term, forgo short-term profitability in order to be able to scale longer term in this new technology. Value stocks tend to be, what you see is what you get immediately. So there's a little bit more faith in the future, I would say, when it comes to tech investing. And, I'm certainly over 50 and, I'm all about technology. So a bit of maybe an exception there. But I do think there's just a general discomfort, especially because they lived through the tech and telecom bubble and bust. And they weren't looking at it with the perspective I just shared with you, which is, okay, these seeds were planted back then. They weren't ready. And so if you weren't doing the kind of research we're doing in terms of trying to figure out when technologies are ready for prime time, then they were going to get hurt. And a lot of people did get hurt back then. And so that's a memory. Losing money is painful. It's I know there are studies. You probably know the studies where it's much more painful to lose money than it is enjoyable to make.
Yeah, I think the risk reward on that was the gain of $1 was equivalent to like the loss of $2. So like the loss feels twice as worse as like gaining $1.
Yes. The third way to think of Bitcoin. So we've got technology, global monetary system, and a new asset class, which is why we are really excited. And the ARC21 shares Bitcoin ETF is a good example. We have enjoyed tremendous inflows. And I'd like to think it is because we wrote our first piece on Bitcoin in 2014. We've earned our stripes. We had our first white paper with Art Laffer, Could Bitcoin Serve the 3 Roles of Money? That was 2015. And then we wrote our second white paper, Bitcoin, Ringing the Bell for a New Asset Class. That was 2016. And finally, the SEC approved earlier this year a Bitcoin or many Bitcoin ETFs. So we think institutions have not moved very aggressively thus far into Bitcoin. Why? It's because they need to do their due diligence. They need to, we've spent 10 years doing this, so we're very comfortable. If you look at BlackRock, for example, until I'm going to say 3 years ago, BlackRock was pointing to the negatives associated with Bitcoin. And then, of course, there was the conversion. And fantastic. I think BlackRock has done a lot for this movement of Bitcoin into a new asset class. But we've barely begun on that.
What price targets do you have for Bitcoin? Everyone loves this.
Yes. So we are in print. Our base case is 650,000, but that base case was set before the SEC approved the Bitcoin ETFs. And so we are more convinced now that our bull case of 1.5 million by 2030 is the more likely case.
Do you think Bitcoin is currently a singularity, or do you think it will be that in the future, and when will that be?
So when you say singularity as it relates to Bitcoin, what do you mean?
Like you can't contain it at a certain point.
Oh, I think we've passed escape velocity. There's no way to shut Bitcoin down. And China tried. And all the activity that was in China just migrated. There's no oversight. There's no throat to choke. And it has proliferated to such an extent and is serving a really important role, especially in emerging markets, where people, of various countries, if their leaders either don't understand economics or there's corruption, and they lose purchasing power and wealth, to the tune of 50% in a very short period of time. Even this year, Egypt, I think it was the beginning of March, devalued the Egyptian pound by 40%. And so having an insurance policy like Bitcoin is really important in emerging markets.
So the bear case for Bitcoin isn't even that it could just go nowhere, but that it will 20x in 5 years.
I mean, you've seen the corrections are violent because it is so early and so young. The corrections used to be 95%. Now they're more like 75%. That's a lot. So I don't want anyone to think that it's straight up and to the right, because the corrections are pretty violent. They're getting less so. And I think as Bitcoin moves more into mainstream investing, the volatility will go down dramatically. So it's not like we're saying it won't go down. It will. It's a new asset class. And there are a lot of, I would say, weak holders. They get in because of FOMO, so fear of missing out. And then they lose 20% and then they get out. They cut their losses. So that exacerbates moves down. So
Michael Saylor said something that was really interesting. And I think, I don't want to misquote him, but he said the only true threat to Bitcoin is a competitor that is somehow better.
Bitcoin is backed by the largest computer network in the world, and therefore it is the safest cryptocurrency or crypto asset out there. It has not been hacked. The base layer has not been hacked. I don't think any other crypto asset can say that. So, this is like a giant neighborhood watch. You've got a lot of people whose livelihoods have been built on Bitcoin, starting with the miners in the Bitcoin ecosystem, and they are all watching to make sure that this ecosystem is as robust and hack-proof as possible.
Now, hypothetically speaking, what would it take in Bitcoin to convince you that you were wrong?
Well, there is one thing that the Bitcoin community is watching, and that is quantum computing. But as I always say, when it comes to risks, half of the solution is understanding the problem. And so now developers are thinking in terms of quantum proofing. So I think that is something we should consider seriously. And I am happy that, the developers are considering it seriously because, again, half the solution.
Do you think there are any other drawbacks to Bitcoin?
Well, many people would call drawbacks like higher cost than other solutions, slower transaction settlement times. But to us, those are features, not flaws, because it's part of why it is the safest ecosystem in the crypto asset world. So we don't look at those as issues. We look at them as really they've been built into the ecosystem to assure its success as the safest crypto asset ecosystem.
And how do you see the regulatory environment changing for Bitcoin or cryptocurrencies in general?
What has happened, the U.S. has been the worst. Gary Gensler, as I've said many times, has been a menace to our ecosystem and has pushed a lot of innovation associated with Bitcoin and other crypto assets into the rest of the world. So much so that many of the innovators who have moved to other parts of the world, whether it's Switzerland or Berlin or London or Hong Kong, Singapore, they will not deal with U.S. investors even. That's how bad it got.
Why? Why?
Because they think they'll be tainted because we are regulated by U.S. regulators.
And why are U.S. regulators so strict? Like more than any other part?
When you're a regulator, there's a lot of power seeking, and we know the history of the SEC and the CFTC. They've butted heads over the years, right? And we saw this during the derivatives, the evolution of derivatives in the 90s. And finally, with, I think, a Supreme Court ruling, they both regulate it, but regulate different parts of it. That is what I think was going on. There's a power struggle in the regulatory ecosystem. This is my purview. And so we may go to the Supreme Court again. I don't know. I think that was the main issue.
Yeah. To me, it seems a bit like, because we've worked with a lot of lawyers, and they're overly cautious.
Yes.
And they don't want you to, do anything that could, put you in harm's way, let's just say.
Yeah.
So I almost think of regulators as like being overly cautious on everything, like not even take a risk, not even do anything that could cause any casualty to an investor. Let's just say.
Yes, that is true. But now there's something called regulatory arbitrage. And so that's what I mean by other countries very interested in attracting innovation are one-upping us. And I'll give you our first example when we started ARC in 2014 was drones and the Federal Aviation Administration. So Amazon was on its 9th generation drone back in 2014, and the FAA would not let Amazon fly its own drones on its own property outside. It is only in recent months since that has changed. But in the meantime, one of the companies in our venture fund, Zipline, seems to have ingratiated itself with the regulators, meaning it has, what we've observed is it has taught the regulators, prepared them every step of the way, for what they were attempting to do. No surprises whatsoever. So the FAA did start opening up a couple of years ago to Zipline. Zipline has a pilot going with Walmart in the Dallas, Texas area to deliver parcels. So, and so Zipline beat Amazon to its own game, which is really interesting. So, but this regulatory arbitrage, other countries, so Amazon went to Hong Kong, UK, Australia, India to test out its drones. And then the FAA became a little bit more understanding. I don't know why they didn't give the green light to Amazon sooner, but they did start giving the green light.
Although really quick, if you run a business like us, you know that handling the back office finances could be a pain. It's a huge headache. You have countless cards, receipts, and payments to keep track of. And then as your team grows, you add more company cards, receipts, and payments. All of this could be a real nightmare and very confusing and time intensive to keep track of. But it doesn't have to be that way with the sponsor of today's episode, Ramp.
Ramp is the corporate card and spend management software designed to help you save time and put money back in your pocket. With Ramp, you get full control and insight into company spend, issue cards to every employee with customized limits and restrictions, and you can automate expense reporting. So that means no more chasing receipts and endless expense reports because Ramp software collects and categorizes expenses in real time, letting you close your books 8 times faster.
Plus, Ramp helps you save money. Businesses who use Ramp save an average of 5% in their first year. It's also incredibly easy to use. You could start issuing virtual and physical cards and making payments in under 15 minutes, no matter the size of your team.
And now get $250 when you join Ramp.
All you got to do is go to ramp.com/ICH with the link down below in the description. That's spelled RAMP.com/ICH, ramp.com/ICH.
Cards issued by Sutton Bank, member FDIC.
Terms and conditions apply. Thank you so much, Ramp, for sponsoring this episode, and back to the podcast.
How do you approach stock picking?
To understand that, you need to understand a little bit about the starting point of our process. So as you interview other asset managers, they probably talk to you about bottom-up investing. Bottom-up meaning company by company, we look at the companies and they teach us how the world's going to work. We don't do that. We actually start from the top down. And we are as bottom-up stock research driven as any other team you'll find out, but our starting point is top down. What does that mean? We center our research around something called Wright's Law. And when we hear of a new technology, so I mentioned the 5 platforms, they involve 14 different technologies. So when we're looking at a new technology, and this is all we do, so we better find these technologies as they are evolving. We will take a look at it and say, okay, how quickly are the costs associated with this technology going to fall? And there's a very predictable way to find that out. So have you heard of Moore's Law in the semiconductor space?
That's
No.
the halving thing or the
It's-
doubling?
It's twice the power at the same cost every 18
Right.
months to 2 years. Roughly, that's very roughly it. So that is a function of time, every 18 months to 2 years. So it's worked extremely well in the semiconductor industry until recently. Now semiconductors are hitting up against the laws of physics. And so what's working better is what we use for every technology. And it's called Wright's Law, W-R-I-G-H-T. Theodore Wright was a civil aeronautics engineer in the early days of airplane manufacturing. And he just happened to notice, as he analyzed the costs, that for every cumulative doubling in the number of airplanes produced, there was a cost decline consistent. Today, we can do that for all the sequencing technologies, DNA, RNA, protein. We can do that for robotics, blockchains, artificial intelligence, energy storage, robotics. And we have a number associated with each one. And what we have to do is say, okay, as the units go up and the costs come down, when will those costs and lower prices open up this technology to a whole new sector, especially the consumer? And so that is what we do. And as we're doing the work, looking at this new technology and trying to figure out that cost decline, we do a lot of our research in social media. We're putting questions out there, or we're putting our research out there saying, hey, this is what we're finding out. Anybody know anything about this? And we'll get CEOs calling in of companies who are in the space. That is very often how we find new companies. We're starting this top-down research, and that we have a dialogue going out there. So, and we also have brainstorms. We have a brainstorm every Friday, and that will be where all of our analysts will be getting together. And about half of the people on the call are outside. They're outside of ARC, but they're passionate about innovation. And they're willing to spend 2 hours every Friday brainstorming. And very often we will get an idea, just like, aha, okay. One of the ideas very early on was when we did our autonomous taxi work, so robotaxi work. Many people think that, robotaxis, as they proliferate, and we think we're getting close to prime time there, that traffic jams will go away. No, they won't, because if the costs come down the way we think, there's going to be much more congestion. Many people will take robotaxis. And so that pushed us up into the sky. That's what started our eVTOL work, so electric vehicle takeoff and landing work. So one thing will lead us to another. And in fact, very early on, we learned that NVIDIA was going to be the AI play of the century in 2014 when Tasha Keeney, who has done a lot of our robotaxi work, going through original research, white sheet of paper, what's an autonomous vehicle, and going in, doing research in academic, in universities, on social media, learned that the brains or the central nervous system of a robotaxi are going to be GPUs. No one knew that at the time. They were just PC gaming chip companies. Nothing. NVIDIA was nothing more than that. It was commodity. And that's when we started legging into NVIDIA in a big way.
Interesting. Okay, so help me understand. You're saying that that Wright's law, that sounds kind of like, if I'm using this correctly, economies of scale,
Yes.
where like obviously as it gets bigger, it just
Yes.
becomes cheaper to produce. You're applying that to probably AI. So AI access gets cheaper. So then that will then proliferate across everything, and everyone then can then use AI. So then you're betting that on these probably smaller market cap companies, now that they have access to cheap AI, are going to just explode.
You've got it. There's a lot of drama going on in these price declines. So AI, for example, based on our work, when you combine hardware and software, for every cumulative doubling, and this unit, and this is the most important thing we have to find, what is the unit dynamic we're measuring here? And it is amount of data per unit of computing power. For every cumulative doubling of that, costs decline when you combine both hardware and software 48%. But the drama is the per year number. That 48%, that cumulative doubling, is happening in less than a year's time. So that AI training costs are dropping 75% per year. AI inference costs. So you put into ChatGPT a question, the answer, the costs associated with that, the inference costs, down 85 to 90% per year. That's why AI is booming.
How do you respond to criticism? And how do you know what to listen to and what should just be disregarded?
There's a lot of noise out there because we are on social media.
Yeah.
I have a very thick skin. I used to face it more inside the industry and still have that. And maybe even inside my own companies, because what we were doing at each of the firms, especially the last one, was so different. Wright's law, cumulative doubling, starting from the top down, all of that was so different that people just didn't understand it. And so that turned into perhaps a lack of respect for it, which, I would prefer to explain it and, help show them some of the things I'm explaining to you, so that they can see the merit in it. So just to give you a sense on Tesla, how much hatred spewed out 2018, 2019, production hell, it's going bankrupt, you're idiots, and a lot of that was for clickbait, and we just didn't pay attention to it because we knew those people weren't doing the work. The people who are doing the work, they want to engage with us to understand why we think what we're thinking, and how did you, even if they understand Wright's law, there's something that's not connecting. Those are the people we really listen to and I can give you an example. In battery technology, the semi-truck batteries, Carnegie Mellon has a professor focusing only on batteries. That's all he does. He DM'd us. He DM'd Sam Corris, who does all of our battery work, and said, I think you're wrong on this. I think, and so they compared notes, and actually Sam was half right, or maybe all right, I don't know, but they morphed so that research on both sides was better. Think about that. That's a university professor. All he does is batteries. That's huge for us. That's the kind of DM we will respond to.
That's fascinating. And that's 100% true. Like, we will get comments that will be negative and they're talking publicly on a public forum. But then in the DMs, people are always so kind, and hardly ever do people, surprisingly, I feel like, send criticisms over DMs. And if they do, I'm way more likely.
You're right.
I'm like way more likely to respond to it. And it seems like it's actually criticism rather than just like a flagrant, just trying to make fun of you or offend you or something like that. It's like a different natured person.
Those are the people who are trying to get just public endorsement almost, that they're trying to promote themselves by critically talking about another person. But when it's private, it's sincere and they're not doing it for the wrong reasons. That's a great point.
And altogether, ARC has 3.5 million followers, I think, on X. And so when people are, hating on us or whatever, maybe that's exaggerating a bit, but not really, then they know they're going to get a lot of publicity because of the number of followers. So we're a target. And so and we understand that. It comes with the territory, but we would never meet if we were doing things the traditional financial way. We wouldn't meet the people we're meeting, and they wouldn't have as vital an interest that we're getting our research right. Yeah. So just to give you a sense of that, what are we doing from the top down? We are sizing the markets these innovators are going after. They're not doing that, but they're vitally interested in it. How big is big? And so they want us to get this top-down work right, because they also want to know, okay, how big is this opportunity I am chasing here? So it's a win-win.
Do you think that maybe that works to your advantage to be a little bit more controversial in a sense of picking investments that maybe people are more emotional about? Like Tesla was a great example of that.
Bitcoin has been a great example.
Too. Yeah.
I mean, Roku's a great example. Coinbase, great example. Jim Chanos, I think he's shutting down because he shorted Coinbase. We are not contrarian just to be contrarian, but because we start from a different point of view, the top down, it's inherently controversial. We are, for example, you mentioned Tesla. In the early days, we were making what to many people sounded like a crazy forecast about how quickly electric vehicles would take off. The traditional auto manufacturers back in 2016, 17 were saying maybe in the 2030s. And oh, by the way, that we have the install base and we'll be there. And Tesla, you're a flea. That's how they often treat the innovators early on. But we knew that Tesla's DNA was so different. And we also knew what Wright's Law was saying about battery technology, drivetrain technology, and that those costs for every cumulative doubling were dropping 28% per year. And particularly because Tesla built its cars on top of the consumer electronics battery, which is laptops and cell phones, whereas no other auto manufacturer was doing that. They were creating, this huge battery that kind of looked like an engine, or certainly the same form factor, not lining the bottom of a car, right? So they weren't talking the same language. Sure, that battery was probably late 20s, early 30s. But Tesla's battery was ready for prime time if he could engineer it correctly. And they didn't think he could. So we were just talking a different language. That's all.
What do you think the biggest risks are for the stock market these days in 2024, 2025?
I really think we're going into a deflationary period. And most people have never seen that. In fact, it really hasn't existed since the Great Depression. And any company that is highly leveraged and doesn't understand that prices are going to be falling for two reasons, I'll get into that in a moment. Any company that does not understand that and has a lot of debt is going to be in trouble, because falling prices means it will be very hard to service that debt, certainly the way they expect it to. So why deflation? And this is really controversial. I came out of an economics background. And so I do something called In the Know every month on Employment Friday. And we've been building this deflation theme for a while now. And now it's happening. So you're seeing McDonald's cutting prices. You're seeing even Starbucks cutting prices.
Where are they cutting prices? Because I go to the same Starbucks every single day. 1 cup of venti coffee, $3.52 on the dot. Hasn't changed.
Well, you aren't buying one of their package deals that they are now cutting prices on. So, yeah.
Okay.
Yeah. So it's, believe me, for Starbucks doesn't do this, but they've broken down and they're doing this now for some kind of breakfast special, I think, for not much more than you're paying for your
My understanding with that, though, is that Starbucks is somewhat losing popularity among some younger people, also because there's so many other places out there, and their prices are so high.
Because Starbucks is expensive?
It is.
Yeah.
Well, yeah.
wildly
I mean,
expensive.
how hard is it to make a coffee?
You
I
could
feel
make
like it's
it at
just
home for
like
20
It's
cents.
extractions from a bean and water. You know? Yeah, you
Well,
can make it at
bean
home.
prices are going up a lot, so coffee prices.
He owns a little coffee company, so he's got
okay.
he's got to defend the bean prices.
Thanks.
Yeah,
Coffee.com.
well, I just use Keurig and put a little pod in there, and
Yeah.
I
But
have
even the
delicious
Keurigs are
coffee.
expensive.
Yeah.
The $1,
they-
$1.20 each.
But much less expensive.
Right.
My old habit was Starbucks, right?
Yeah.
So,
But my point with Starbucks, I think they're kind of losing popularity.
well, and part of it's pricing. And what has
Yes.
brought that on? So there are two reasons we think prices are going to fall.
Yeah.
One, during COVID and the supply shock, it was almost permission for companies who would never raise prices by 20% to raise them by 20%, which they did, including cereal companies, and a lot of necessities. Real wages did not go up that much. Maybe they did for some union workers that got 10% per year for 4 years, but that's not many people. In fact, probably that's certainly it's less than 10% of the people in the United States, probably less than 5%. The rest, their real wages didn't go up. Their wages didn't go up to compensate for that. And so now we're starting to see the saving rate, which hit 32% when there was all this fiscal stimulus, just giving checks for not working. Now those are gone. So the saving rate has gone from 32% at the peak to 3.9%, very low by historical standards. And we're also getting to a point where if you look at various surveys, people who are making more than $100,000 a year, so roughly 2 times the national average, the percentage worried about losing their jobs is increasing dramatically. And I think that's because of all the tech layoffs, a lot of tech layoffs, if you've noticed. And that's because they're harnessing artificial intelligence as their margins are under pressure. So we're seeing prices go down and hitting profit margins. What happens? What is the easiest way to salvage those margins? The easiest way is to, unfortunately, lay people off if you have technology to take over what they're doing. Because labor is the biggest cost in an organization for the most part. So I do think the unemployment rate is going to go up, and cyclically prices are coming down. We're hearing about every day there are prices coming down. So Walmart's cutting prices on either 5,000 or 7,000 different items. Target, of course, and Costco as well. Best Buy. So we're seeing this now. More broadly, food away from home, definitely. That's a bad reason. That's cyclical pressures. The good reason is innovation. I just gave you some statistics on how quickly costs are falling. If those companies are smart, they're turning those cost declines into price declines so that the units can continue to proliferate and drive costs down. Economies of scale, efficiencies. And so that's a good reason. Why? Because when you cut prices in these new technologies, units boom. Okay, that's good for the economy. But then there's another bad thing that happens. If electric vehicle prices are going to continue falling, let's say if Elon's right, we will get a $20,000 to $25,000 car in the next year or so. What's going to happen to the prices of gas-powered vehicles, right? They can't cut prices. That's a mature technology. The cumulative doubling is not going to happen for 100 years.
But why are EV prices falling so much lately?
It depends. Are you including
used cars? Like
the
used market.
That's because Hertz started proliferating its fleet with Tesla vehicles in
Is
particular.
that why Elon was so against Hertz buying their cars?
Well, he probably expected what has happened. So the reason Hertz did put them into its fleet is because the maintenance associated with an EV is 60% lower than the maintenance associated with gas-powered vehicle. I mean, they have, I don't know, a sixth of the parts or something. Much less can go wrong. But what they didn't anticipate is the infrastructure is not ready quite yet for cars that have been in accidents for there to be replacement parts in any short order. And so I think that's the main reason. We think they're making a big mistake taking them out because that's going to happen. And if we're right, what I just described, this prices continue falling in the electric vehicle world, and new vehicles have to, gas-powered vehicles have to try and match them. That will take up all of their profit margins, and that will continue to put pressure on the used car market, which went crazy.
What's one of your most provocative opinions when it comes to investing?
Well, this should not be provocative, but we look out, our investment time horizon is 5 years in the public equity markets. And we are willing to buy companies that are losing money now, especially in the early stage technologies like multiomics. Most people right now have a 1 quarter time horizon when it comes to that kind of company. We have a 5-year investment time horizon. And let me just give you a sense. Many people say, oh, well, you'll just buy anything, no matter what the valuation, as long as it's in, the sweet spot of innovation. That's not true. What we do is we make the assumption that, the valuation metric we choose is enterprise value. So that's not just equity market cap, but it's fixed income as well. So the entire capital structure is what we take into the numerator. And then EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. That number, if you use the S&P 500, and you adjust for stock-based compensation, which we feel is important when it comes to innovation companies. They need to be aligned with shareholders. The S&P is over 20 times on that basis. Our portfolios today, I've never seen the premium so low, are at about 25 or 26 times. Normally, we're much higher. I'd say normally we're double that. But what we assume is that in 5 years, that our multiple is going to be a market multiple. Actually, we're at 18, 19, so sub today's market multiple. And so there's a massive headwind from a valuation that we assume in the next 5 years. And what we must believe, or our analysts must believe, is that the revenue growth and margin expansion associated with these new technologies is going to overwhelm that headwind to deliver a minimum hurdle rate of return of 15% at a compound annual rate. So that's 15% on average per year. Now, we have not done that because the interest rate shock it was so severe. We had never seen anything like that in history, never. Mm-hmm. But if you look at to date, from inception to date, we are in the double digits, nearly 11%. But our goal is 15% minimum certainly over the next 5 years. And, our rate of return expectations based on the stocks in the portfolio right now are multiples of that.
Here's an interesting question. Do you think the stock market should be open 24/7?
Well, we're dealing with the crypto asset world being open 24/7. And so we have conversations at night around crypto assets. So it certainly extends the workday. I think it would develop into a cadence. There's a time during the evening that most of the activity will occur. It's as one market's closing and another one's opening. So I think we'd probably have to hire. I mean, I wouldn't mind it. I think I wouldn't mind it if markets were truly efficient. I feel that markets are so inefficient right now because our world has not ours, ARCs, the traditional asset management world in the public equity market has gone passive, or the various strategies out there hug benchmarks. So, for example, the Mag 6, according to Morningstar, in June, the average large cap manager in the U.S. had 45% of his or her portfolio in the Mag 6. 45% average. That means some were over 50%. That's no way to manage money. Now you can say, well, it's been right. Well, there's been a little bit of a self-fulfilling prophecy there. And I think as the market broadens out, that will change. Does it mean the Mag 6 will fall apart? I don't think so. I just don't think they will do as well as as our portfolio, for example. But the rest of the world is not positioned that way. They're going to try and get into the stocks that we've been legging into as the market has been treating them very poorly, which is a bit of a contrarian way of managing money. You asked what's so contrarian? That we buy stocks when they've dropped 30%. Most strategies, when they describe what they do, momentum is a part, either price momentum of the stock itself, revenue momentum, earnings momentum. And as I just described to you, we have a 5-year time horizon. So they're talking about this quarter when they say momentum. We're not relating to each other, right? So if we think that because they missed their operating margins by 0.3% or 30 basis points, and that they have told us that they're sacrificing short-term profitability to invest more in R&D in an area that we think is really important, and it's down 30% for that reason, we're going to be buying that stock. So we are what's called a liquidity provider. When you get those massive sell-offs, not every stock, but if it's a stock in our universe and we think this is ridiculous, they have no idea how big this story is going to be over the next 5 years, we'll be buying it. The other side of that, and we got a lot of publicity around NVIDIA that when we did this, if we think a stock has become so momentum driven, just momentum for momentum's sake, and there were reasons. NVIDIA just shocked people with their revenue and earnings growth. So we still own it in some portfolios, but we pull away from that kind of a stock because we figure, okay, if NVIDIA is going to deserve this valuation, if it's going to deserve $3 trillion in market cap, which is nearly 15% of the U.S. economy. But if it's going to deserve that, then it must be serving other companies that are going to benefit enormously from it. And so far, you're not seeing huge upside surprises for that reason.
And what do you say to investors who believe that's too risky and say it's safer to invest in a broad market ETF passively, like something that maybe, tracks the S&P?
I will say it'll be less volatile. And because the pendulum has been swinging towards indexation and the broad-based indices in particular, this has been a winning strategy over the years. If we're right, and these 5 innovation platforms involving 14 different technologies are going to transform the world as we know it, the S&P 500 is the world as we know it. Now, it will catch up slowly over time, but as we learn with Tesla, it took until nearly $500 billion in market cap for Tesla to have a 4-quarter moving average of profitability with the last quarter profitable. That's the S&P's rule. A lot of our companies will probably be, now they're 1 to 2 billion or 5 to 10 billion, and they'll be similarly 200 to 500 billion. And that's okay. The S&P will catch up. But it will also have some losers, those companies that are going to be disintermediated, disrupted, destroyed. And, so it'll have that weight. Nonetheless, it'll be less volatile than we are. We're a nice hedge to the value traps that are in traditional benchmarks. Those companies that are going to be disrupted by the new world, we're a hedge. We've had some value managers saying, I wouldn't own one stock in your portfolio, but I know my biggest risk is a value trap in the portfolios I do own. And so, I'll use you as a hedge, 1 to 2% of my equity exposure.
So I've been traveling quite a bit over the last couple of years, from Mexico to Croatia, Thailand, Japan, the Philippines, and I know that language gaps can be quite intimidating and unfortunately prevent people from seeing the world. But guess what, guys? You don't need to worry about that anymore with today's sponsor, Babbel.
Babbel is the language learning platform designed for real people having real-world conversations. Their fast 10-minute lessons are handcrafted by over 200 expert linguists to help you start talking in your new language in as little as 3 weeks, because talking is the key to learning any new language.
Babbel's tips and tools are grounded in the real-life stuff you'll actually need, so everything is focused on conversation, and you'll be ready to talk wherever you go. In fact, I was actually just in Mexico a couple of months ago, and I gotta say, it was incredibly helpful to have Babbel to help me brush up on my Spanish skills so I can talk better with the locals, order at restaurants, get drinks, and honestly just find my way around better. It overall just helps me be more comfortable and confident in a foreign country. And a big piece of this confidence comes from Babbel's speech recognition technology, which helps you refine your pronunciation and your accent.
So don't pay hundreds of dollars for tutors or waste hours on an app that doesn't really help you speak the language.
And for a limited time, we have a very special discount that is up to 60% off your Babbel subscription just for our listeners at babbel.com/ICH.
Again, get up to 60% off at babbel.com/ICH. That's spelled BABBEL.com/ICH. Rules and restrictions may apply. Speaking of Tesla, how often do you speak to Elon Musk?
You'd be surprised how little we do. I mean, we can, if we wanted to talk to him, we could talk to him, I think, almost any time. He knows we're not going to bother him unless there's something really important. We have a 5-year investment time horizon. We've put our Tesla model out for the public to see. And it's gratifying to have at the shareholders meeting, to have Elon 3 times mention our research as being closest to what he believes the mark will be. So as long as we feel like we're on the right track, we're not going to be bothering Elon. We want him to use his brilliance on all of his companies. And many people do ask that question. Well, isn't he distracted by all of these companies? He is the maestro. He is the maestro of what we're calling the convergence between and among the technologies that we're researching. He understands that the key to the new world is data, big data. And so he's generating data out of all of these companies. And one of the most surprising places, Neuralink, in the healthcare arena, they're generating all kinds of data about the brain. What are neural networks in AI? They're patterned after the brain. So, he's got that data. He's got all the real world driving data from Tesla, the 5 million robots roaming around the world who are sending data back every day on the corner cases. You look at X, that might be some of the most valuable data out there. And Boring has transportation data. So he's getting data from all over the place. And of course, XAI now would be another place that he's seeking to generate data. So he understands that the winners in the new world are going to have the best data, most comprehensive data, the most reliable data in the world. And, I often say that the big surprise out there is multiomics data, the biological ecosystem might be the most valuable data out there. And so that's why many people say, why why are you so invested in this space that has acted so terribly, the multi-amic space? And the reason is we think the most profound applications of AI are going to be in healthcare, going to cure disease.
Is there anything that you think is misunderstood about Elon, whether that's just from, viewing him online or from private conversations that you've had with him that you think should be known by people?
Everybody's well aware of his very high standards. So, but we did a podcast with Elon in March of 2019, and this is where I learned what I'm about to tell you. He is a very good and honorable person. He is trying to do right by the world. And, I don't think people understand that. I don't think people understand what a good, honorable, decent person he is. Sure, on Twitter, he says some outrageous things, and I don't know what spurs him in any given moment, and maybe venting or something. So I don't look at what he tweets unless it's about the companies and the technology. Then I'm all over it. And so are our analysts. But I know from speaking with him that he is a very good person. The other thing is many people think he's so headstrong that it's his way or the highway. You hear that a lot coming out of his companies. But what he said to us back then, and I've heard him say this in other venues as well, is the most important thing that we could do, our analyst team, and what I could do, is if we vehemently disagree with him on something, to call him on it. And, we don't vehemently disagree. I know I didn't call him on it. I just remember saying something. It was minor, but, he took it in, and I could tell modified at least what he said about it. So
that's good to know. That's kind of what's also been mirrored by other people that we've spoken to that have also spoken to Elon. And I always thought that's really good to know, because if he was secretly a supervillain, I think with all of that data access.
Yes. In fact, quite the opposite. He's the first person to warn that AI could be used for nefarious purposes.
He has said that, yes.
And let's watch out. So the more he knows about it, and you never know what he's doing to protect humanity against ourselves.
Do you think there's that danger with AI? You hear Elon Musk saying it's going to take over the world, it's going to be destructive, it could be a bad thing. Do you believe in that?
All technologies can be used for nefarious purposes. That's why we have cybersecurity the way we do now. So yeah, I do. I mean, from the simplest examples of, we all know what a hallucination is now from ChatGPT. And can you imagine a sales team generating emails to customers saying, wow, I'm so productive now. And in the email, there's a big insult of the customer. Your product sucks.
But I think Elon is almost implying that it could be the downfall of humanity. We could have a Terminator sort of instance where AI becomes self-aware, starts communicating, could take over the world. Do you think any of that is possible? Can we go down that path?
I'm going back to my premise, which is half the solution is understanding the problem. And I am so glad that there's so much science fiction out there along those lines that, a lot of people focused on technology today have been reading science fiction for years. So they are thinking about this problem maybe as narrowly as relating to their own companies. But, you get enough people worried about the same thing, you lower the risk that it happens. And then you've got big thinkers like Elon and others who want everyone to be aware that, there are nefarious actors out there.
Yeah. What are your thoughts on the housing market?
Yeah, it's interesting. We just did, every week I do an economics meeting. At first I did it just to see if anyone would be interested in the firm. And it's unbelievable how many people are interested. One of the reasons is housing. Okay, do I rent or do I buy? And, the unaffordability or the affordability index for housing, as you know, is at
40 something year low.
09. Yeah, it's lower than 08, 09, which is really saying something. That gives you a sense of the shock that started when the Fed raised interest rates 22-fold and locked people into their 2.5% mortgages. They can't sell. They can't sell unless their price is going to go much higher than it is right now. So I think the housing market is pretty stuck. And it's interesting, knowing your interest in real estate, I asked the team, my analyst team today, okay, what are you thinking in terms of housing here? Because I had heard a number of them were thinking about buying houses here. And they said they've done the analysis. Now, our analysts are, of course, in the investment world. So they're thinking like investors and doing a trade-off analysis because their trade-off is, okay, am I going to use this money to put into housing, or am I going to use it to put it into the stock market and I'll just keep renting? And they do that analysis and it doesn't make sense to buy a house. It doesn't. And they were doing some analysis. Our Nick Grusa, an associate portfolio manager, apparently has a program, and he puts in the interest rates and the rent and the purchase price, and just to see. So he's thinking rent, buy, or invest in housing. And the only thing that makes sense to him right now is renting.
Yeah. The New York Times has a calculator that goes through every single variable that you could think of, from your investment returns, closing costs for housing, repairs for housing, everything. And in most cases, renting makes sense and will be more profitable anywhere between 10 to 20 years.
Wow.
With investment returns. It's only around year 20 do you start to break even, depending on the market and your investment returns. Obviously, they could fluctuate if the market goes down over the next 10 years. We have no idea. But 10 to 20 years just to break even. So, I mean, if you buy a house with the intention of keeping it for the rest of your life, it could make sense. Mm-hmm. Assuming rents are increasing, I think when I did it, 3 to 5% a year.
Yeah.
So
what would change that, of course, is prices coming down, interest rates coming down. That could change. So this world of deflation that I'm talking about, I'm not predicting it for housing. It's not what I do, and but when I hear that and people say, okay, this is not going to change, then I think, well, how could it change? Well, if prices came down and interest rates came down, that's how it could change. I don't know if that will happen. But, a lot of people are stuck, like baby boomers are stuck in their homes. Okay, at some point they are going to make a decision. All right, I'll take a hit on the house. It's worth a lot more than when I bought it. I thought I'd get 20% more than I am going to get, especially during COVID. So fine. So we could see a little bit of that kind of decision making at the margin. So I'd look out for good deals still, because the one thing you can do in your own house is you can change a lot of things, right? You can do renovations. You can suit it to your own lifestyle. You have to jump through hoops to do that.
But I feel like as a renter, you could do something similar by moving.
You could, especially there is so much supply coming online. There's, I think, 1 million units in multifamily dwellings that will come onto the market new during the next year and a half. We have not seen that kind of supply since the 70s, when real estate was a tax shelter, which it is not now. Mm-hmm. It's not compared to what it was back then. And so we're already starting to see rents coming under pressure here in St. Pete. And there's a lot of people moving to this area. So the supply is also coming on.
Yeah. The only flip to that is that multifamily is increasing a lot, but not single family. And so for single family rents are actually increasing, whereas multifamily rents are declining. So if you want an apartment, great deals right now.
And one thing, one of the reasons I've been watching multifamily is because of private equity, private credit. There was just a wall of money just waiting to get into that and into some investments. So what was that? It was from 08 to really until now. It basically was a search for yield. So what did this private equity do? They bought multifamily dwelling units, leveraged them up, to get maybe a 15% yield, so to speak. So if rents are now coming down, leveraging up will, in hindsight, look like a very bad idea. So I think there's trouble brewing in private equity when it comes to real estate. Myself. Now, that's just a guess. It's not my world. I just look as an economist and say, okay, there was a reach for yield for, almost, well, how many years would this be? 10, yeah,
12
it'd be
years,
16.
14.
So yeah, for that long. And it was a no-lose situation for a very long time. Whenever I see that, I say, okay, then there was too much of that happened, and there will be hell to pay. Just like with China. In China, when it came to property, after China entered the World Trade Organization around 2000, the right thing to do during every massive correction, and they had big corrections in property, every time a person bought the dip, and they won until they didn't. And I think in China, the real estate issue and the overwhelming debt load is much worse than people understand. And we're beginning to see it in all kinds of numbers. This week, luxury watch numbers came out, Richemont and Swatch. They're down 25 to 30% in China, which is dragging their entire sales down by 10 to 25%. Think about that. These companies have never seen anything like that. People aren't talking about this.
How do you feel like that's all affecting the middle class here in the United States, with housing prices being the way they are, the stock market's at all-time highs, prices are, still rising throughout a lot of segments? Do you think the middle class is in some ways kind of screwed?
No, I think the middle class now has a lot of power because as we've watched other cycles, what really causes the cycle? It's when, not as much when lower income, they've been killed by this environment, not when they get hit. It is when the middle class starts to change its behavior that we have big cycles. And the middle class is changing its behavior and insisting on lower prices. They're trading down to private label if they don't get lower prices. So now we're seeing brands who have never had to cut prices. Now, they've never raised prices the way they did during COVID, but they've never had to cut prices before. They're cutting prices. They are cutting prices, and it is the middle class. And I think that's going to be the same with rents. The middle class will double up, and so forth. So I think the middle class, I know a lot of people say, they're screwed. I actually think they have a lot more power and that they should use it. They have a lot more bargaining power than they know.
Is any part of you concerned about the national debt, or do you think that that's kind of like a false threat? Everyone's saying, oh, it's getting bigger, it's getting bigger. Obviously it sounds like a very scary number when you think about it, but does that even affect the average person? Will it ever affect the average person? Is it fine if it just keeps climbing and we never pay it off?
I started in the business, and this controversy was plaguing Ronald Reagan when I started in the business. So I thought about it a lot. And this can go one of two ways. It's well publicized now that our interest bill is higher than our defense bill, which is terrible, right? So when I say one of two ways, if we move into an environment that encourages more innovation, because there is so much innovation and it is booming, it's going to happen no matter what. It's just how quickly it's going to happen. If there is more incentive for innovation, I think we will grow our way into a much better situation, much like we did during the Clinton administration. The growth rate of nominal GDP was faster than the growth rate of debt. So debt to GDP started falling. And I think that could happen again. It probably will happen. The question is how fast it will happen. If we get into a regime where, and I think regulations are a killer. They're a killer when it comes to this, especially for small businesses, which is where a lot of innovation does take place, or at least risk-taking takes place. If we get rid of regulations, and I think that's part, I haven't seen the entire Republican plank here, but I'm pretty sure that would be part of it. That would be huge. And taxes to encourage innovation, writing off capital spending 100% in the first year, writing off R&D 100%, just the including software in the first year. Things like that, I think we could grow our way up because we're at such a beautiful place in terms of innovation history. We haven't been here since the last roaring 20s in the 1900s. Telephone, electricity, internal combustion engine, right? So here we are with these 5 major platforms, 14 different technologies converging. And they will cause explosive growth, but they'll also cause harm to parts of the economy that do not adjust. And I always say one of my biggest messages, if you're going to ask me at one point in this, is there anything you would leave us with? Get on the right side of change in all kinds of ways: education, investment, career. Just get on the right side of change because you'll ride spectacular waves. We really do think they will be spectacular. But if you don't, if you fight this, and people don't like change, if you fight, then you're probably going to lose.
Well, you know what? Before we go into that, if you're a business owner, there's no better sound than hearing. And if you want to hear a bunch more, then it's time to get started with our sponsor, Shopify.
Shopify is the global e-commerce platform that has already helped transform millions of businesses worldwide. For example, Shopify is an endless list of integrations, third-party apps, and flexible templates to help you customize your online store exactly how you want.
And what really sets Shopify apart from their competitors is their ability to turn browsers into buyers with the internet's best converting checkout that's 36% better on average than other leading e-commerce platforms.
And here's a fun fact, guys. Shopify actually powers 10% of all e-commerce in the United States, supporting brands like Allbirds, Rothy's, and Brooklinen in over 175 countries.
In fact, my coffee company, Bankroll Coffee, is run exclusively through Shopify. And when we were first starting out, there's really no other comparison because Shopify was just that good. They were fantastic, and they have an award-winning support team that's there to help you every step of the way.
Once again, guys, it's literally $1 to sign up for a whole month trial period. Start a business, make some money at shopify.com/ICH. Thank you so much, Shopify, and back to the podcast.
Do you think the government can just keep propping up the stock market forever, or just keep everything going and keep printing more money to keep things running?
Well, first of all, I don't believe from a government, I believe government spending is taxation. Just G equals T. And what does that mean? So it's not helping the stock market. That I know. The stock market looks at what's going on right now as low multiple. That's why it's so surprising the valuations are where they are, especially for the mega caps. So that's, and when I say government spending equals taxation, what does that mean? Either they're going to have to raise taxes, which we do not think they should do, or there will be inflation. So you inflate your way out of the debt, right? You pay it off with cheaper dollars. Or there'll be a cut in government spending to actually take taxes down. We're hoping that growth associated with innovation will be, help with that last way of doing things. So I do not believe the government is helping the stock market here. I actually think it's hurting underneath the valuation in the market. In terms of monetary policy, if you look at M2 growth, it went negative in January of 23, and we just moved positive. Now that was after a huge surge, but I think that the Fed has neutralized the impact of money on the stock market. And I think we know that all too well, because our strategy, in terms of what you're talking about, was the biggest beneficiary in 2020. And I didn't like that. Even though it helped us tremendously, that boom was too much too soon. And we were punished in 21 and 22 mightily. So no way did monetary policy help innovation strategies or long duration strategies like ours. In fact, it hurt all long duration strategies, including bonds. Bonds had the worst sell-off in 21 and 22 since, well, the 1700s. It's never been this bad. So all long duration assets. I think the opposite is going to occur now. Rates are going to come down. If we're right on deflation, good and bad deflation, and if the cycle continues to weaken as the consumer saving rate forces consumers to cut back and margin pressure forces companies to lay people off. I don't think it's 08, 09 at all. And in fact, I think we've been through a rolling recession since the minute the Fed started raising rates. Housing went down immediately, right? As soon as they raised, housing started moving down. And by some measures, housing is down 40, 50% still. So housing, commercial real estate, office, and multifamily, so somewhat housing related as well. Autos are punk. Capital spending is falling, even with the so-called Inflation Reduction Act, even with all of that being thrown at it. Capital spending is falling. And now I think inventories and consumer spending will be very soft, but that's the end of the recession. We're not looking into the beginning of a recession. And that's why we are positive.
Do you have any predictions for the new Tesla Roadster? I know in the interview that Elon did with Don Lemon, Don was asking him a lot of questions, trying to pull information about it. Yeah. He was saying like, oh, well, does it have a wing? Does it have a steering wheel? Does it have, is it a collaboration with SpaceX? Does it use like normal? Is it going to, I don't know. Is it going to fly? Do you have any ideas?
Space thrusters.
Like, I don't want to be the guy that's asking if it's going to fly, but do you think it's going to fly?
We don't know that. But I mean, the only thing that Elon said, he actually said this during our podcast. He said that he thought supersonic flight would be electric. That'd be supersonic air flight. I don't think he was linking it at all to what he was doing at Tesla, but that's the only thing that I've heard him say. We spend much more of our time researching robotaxi. That is the most important question. Is this going to happen, and how soon? And, I think the odds have gone up dramatically as we've seen and felt these FSD upgrades every few weeks. So we spend much more of our time thinking about that as, even energy storage or the humanoid robot. We're doing work on it. But if you look at our Tesla model, which is out there, we don't have anything for the humanoid robot. That's a huge call option. And so the Roadster, we'd put in that category. We have nothing for it. We don't need it for this stock to really take off during the next few years.
Yeah. Now, we ask this to everybody, and we get a wide range of opinions and commentary. If you're between the ages of 25 and 50 in America, is it your fault if you are poor?
Well, America both of my parents are immigrants from Ireland. And they moved here because this is the land of opportunity. Your lot in life in other countries, families into which you were born, often determine how successful or not you will be. That is not true in this country. We celebrate, people who use their ingenuity and their grit and determination and their belief in themselves and maybe a higher power that they can reach the moon, so to speak. So is it their fault? I think there are some people who have started in such unfortunate circumstances here. That is also true. It's true anywhere in the world where it is awfully hard. You just need, again, to get a few breaks, but you have to look for them. You have to seek them out. I mean, even in my own case, I met Art Laffer and, I became like, I wanted to learn everything from him. And he loved that. He loved my determination and my grit. And, and he introduced me to the company that accepted me and gave me my big break. So I always say, if you're in a vicious cycle, those can be horrible. And sometimes it's mental health. And so sometimes you need exogenous forces to help you, but you must seek that help. Important is to get into a virtuous cycle. And that is very possible in this country. It's hard. It's not easy, but it's very possible. I remember when I moved to New York, I was so scared because there was that song, Sinatra song, if you can make it here, you can make it anywhere. And I was like, oh my gosh, does that mean it's very hard to make it here? So I remember thinking, I was out to conquer. And I was so motivated. And I think that's, I think you can motivate yourself. But I also think seeking out mentors, critical. Seeking out mentors who believe in you, critical. And they are out there and they want to help, especially those who have been helped, That's one of the reasons that in terms of trying to give back, well, starting a company is one way to do that, especially if we can help people achieve their dreams in terms of, whatever they're doing for ARC. But also in education, I started a foundation and we've taken ARC's research and made it age appropriate for the 6th grade and now 7th grade and then next year 8th grade. And we are in all of the public schools in Pinellas County as part of the science curriculum. This is not after school. Although we're doing after school in summer as well. And what we're doing, our research, we give it away. You see it on our website. That's not being taught in schools. And when I say getting young people on the right side of change means in middle school when there are lots of forks in the road at that time, inspiring them and helping them understand, look, if this inspires you, if this technology inspires you, go for it. Go for it. Follow Sam the drone man, Sam Chorus, who does our drone work. Follow him on X and follow who he follows. You can do this. Mm-hmm. And of course, now with AI tutors, assistants, we're going to be seeing a lot more do-it-yourself in terms of education. And so I think that's also very important for anybody to understand, not just students in school, but we're all going to be students. I'm a student every day. I'm a student. I'm learning something every day. And I have to learn it given what I do. But others can learn too and, enter whole new worlds, we think. So I know I danced a little bit around your question, but there are situations where, they're most unfortunate, but they have to know this country does provide the opportunities. Just find the right mentors and then go for it.
Yeah. This one I'm just personally curious about. How do you deal with the volatility of the market and seeing such large swings? Mm-hmm. Because I'd imagine for you, just like in a single day, it could be up or down, $100 million. Mm-hmm. Do you just become desensitized to it at a certain point?
Well, I'm sensitized to it from this point of view. I think about our clients, and I think it's critically important for us to educate our clients. We're not going to be your entire portfolio. And some people in 2020, we were their entire portfolios. And, we were trying to say, no. Now we have papers, we're writing papers. And so we should be a small allocation and understand this is going to be a very volatile part of your portfolio. We're the closest to a venture capital fund in the public markets. We've always said that. And some people have understood that and other people have not understood that. So closest thing to a venture capital fund, we have a 5-year investment time horizon. We hope you do too. And so I do think about our clients. I think that our distributors, our partners, are the important conduits for that message, but we need to be out there more as well. And it's very important for us to say, look, if we've just doubled in a short period of time, you need to take profits. You need to rebalance, right? Because that will give you the psychological wherewithal that when we drop 50%, you will add back to this portfolio, because over time, we should outperform the broad-based markets by a lot from this level. So I think about it from our client's point of view. Are we preparing them enough, whichever part of the market we're in? And we've been in a very tough part of the market, and just convincing people, there's too much of momentum-driven investing. It's really bad. If you're buying high and selling low, I would think that's a very basic tenet that you're trying to teach your audience. Do not buy high and sell low. Think about the other way of doing this. That's a much more productive way of investing. But in terms of day-to-day on the professional side, we've got a 5-year investment time horizon, and we're surfacing evidence, yay or nay, every day. Are these companies harnessing AI as quickly as we thought they would? No. We've made some important sales in this first half of the year because these companies were not. And this is moving very quickly, and they don't understand. You don't have time. If you don't do this, others will. And so this cleansing out period, I think, has been very important for us with this 5-year investment time horizon. So what we do in the short term, when the market's treating all of our stocks in the same way, we will sell one and benefit longer term from tax losses there and buy another stock that is also down and out.
Yeah. But even in terms, business aside, in your own personal psychology, Forbes estimated, this is Forbes, so we don't know how accurate this is, but they estimated your net worth to be at like $400 million in 2021, $140 million today. This is Forbes once again. So we don't know how accurate it is. How does it feel to have swings? Because some days I'm sure you're up $10 million, some days you're down. How does it even bother you? Like the things that bother an average person, maybe like getting a bad haircut. I'll get a bad haircut and I'll be like, this is unfortunate.
And it happens all the time. All the time.
Thank you.
Jack lucked out with this haircut.
I lucked out with this one, and it will be very unfortunate. Or maybe, like, for example, it rained recently in Vegas and I needed to replace the flashing around my chimney, and then water started bubbling up through my and it's like, for me, it's like, oh my, come on.
Yeah.
But how do you get bothered by normal, what could probably be considered pretty trivial things to you? Does that bother you at all anymore with such having to remain stable through so much volatility?
Yeah, it's interesting to hear that number. I don't hear those numbers, so I don't even think about it, frankly. But in terms of those numbers, they have no idea how much ARK is worth. They have no idea how much crypto I have. They just have no idea. So I'm very blessed. I was a big saver. I took, whenever I had a bonus in my early days, I saved 100% of it, 100%. Now, I came from that kind of family. They never had debt, depression babies in Ireland, no less. So that was kind of drummed into me. But that base became so important to risk-taking in the future, just starting my own business. If I hadn't done that, and if I didn't have that mentality, I wouldn't have been able to fund this business for almost 4 years by myself, So the degrees of freedom that I have had, thank God, really started in my earliest days in the business, just saving everything. So in other words, saving equals investment. That is an identity in economics. That's how I was thinking about it. Okay, I'm saving. And believe me, it was in bonds in the beginning because interest rates were at 15% and even zero coupon bonds. So I was really taking a risk when people were thinking inflation would never come down. But that gave me the base upon which to build my business and not to take out any debt to do so. So it's a mindset. And so I have that base and I can take risks. But that's why when you ask the question, I think about our clients much more when it comes to volatility. I think about our distributors. I just know this is tough on them and that we need to be there. But I also know one of the reasons I left the traditional part of the business is no one is doing what we are doing. Certainly not then. Now they're doing it in the form of ETFs, but not actively managed. They're just throwing spaghetti at the wall and seeing which funds stick, whereas we're very holistic. This is all we do, disruptive innovation. We're going to, live and die on this. And, I think you want us to be, focused on this because there's so much happening. And I think when people see how quickly all of this takes off, we've started to see it with AI, but we're probably in a pause period with AI now, which many people are saying, oh, okay, what's going on? And that pause period has to be with enterprises saying, okay, how do we do this? This is really important strategically, but how do we get all our data in one place? How do we clean it up? How do we integrate it? Who do we work with? How do we organize ourselves? So it doesn't happen, we've got big enterprises to turn around here.
What's something that you wish more people knew about you personally?
What they don't know, because I don't talk about this much. I don't want to get emotional, but I don't talk about my children much because everybody talks to me about my profession and they're the ones who, they've watched me go through this. And, Caitlin, my oldest, I have 3. She'd be 5 and we're in we're in 2008, how old would she have been? So she'd, at that time, 13 years old. Mommy, how is your market today?
Oh my gosh.
Because those were
Graham's
wicked
dream.
days, huh?
That's Graham's dream.
It really is. Yeah.
What?
Oh, to have a child
asked that question.
To have a child who cares about investing and the market and saving is like my dream. I don't have kids yet.
She cared about investing. Because I was trying to get her involved in equities. Not until crypto did my children really become interested in investing. Honestly, not until my son. 2 girls, no. My son, yes, he was interested. The girls, no. Crypto, though, now they're averaging in, that would be my advice in a very volatile category. So that's what people don't know is how much my children went through. Not in a bad way. I think it's good that I was an example in a certain way for them. But, I know it's molded their thinking about the way the world works, how volatile it can be out there, even though I didn't try to bring it home with me. I didn't. My father, every day when I was growing up, my father would come home because he was a design engineer, but politics, he was not good at politics and it was tough. And my mother was kind of his counselor. So we listened to that, every night. And I did not bring home work, but it was our nanny who was just trying to gauge. She'd keep her tabs on the stock market, and especially when we were going through rough times, she'd say, "Okay, we're not going to tell your mother that tonight." If something had really gone wrong, but I'd always find out eventually.
How has having kids changed your life?
There's nothing like it. People, if you don't have children, you can't possibly understand what it is like to have children. It is, I often, when I go to a memorial service for, let's say, someone who has died, what do you hear? What do you hear more than anything? about what mattered.
Or mother, father,
Their
children. Yeah.
If it's a mother, or it is the family. It is just so critically important. And I highly advise it. It's life-changing in many, many ways. Sure, you lose. I was never more exhausted. I had 3 children in 5 years, never more exhausted during those years. I would, all weekend, because the nanny wasn't working on the weekend. We're going to do this ourselves.
Yeah.
And so at the end of the weekend, I'd be walking on Monday morning. And of course, you're using a different part of your brain and a different part of your body and all of that stuff. But Monday mornings were almost like, okay, all right, now let's get back to this. And let's, it was good to be using different parts of the brain.
And Graham just recently got married.
I did.
He's probably going to have children within the next 5 years. He's not in any rush.
Yeah.
Okay. Do you have any advice for him?
Have children. That would be advice. My mother always said this. She was 27 when she got married, which was at that time, she's again from Ireland. She was practically a spinster. Today, that's considered a kid. And 27, she always would say, make sure and get your traveling, all the things you really want to do out of the way. But I will turn that around a little bit and say, I think she did that because we were really financially strapped. And so we couldn't do it. Today, I think it's incredible to introduce children to places around the world. We moved around all the time, so it broadens the mind. And certainly with my children, they traveled and love to travel as well, maybe even more than I do, to see different parts of the world. And so I don't even think that's true anymore. It just depends what kind of vacation you want, how chaotic you want it to be.
Not chaotic, preferably.
Yeah, but if you can afford it, take children, don't deprive them.
Yeah.
Yeah.
I would love to hear you talk just in the future more about being a parent.
Yeah.
And more about having children and raising kids in today's environment. I would love to hear more of that from you.
Sure.
Just more of a personal side. Because I think people know your thoughts on business and the economy and stocks, but just, something that's closer to you, I think, is really important.
Yeah.
What role does religion play in your life?
Very central to my life. And that people do know. I have said that. I mean, definitely one of the reasons I started this company, and it wasn't to start this company and it was more about, you need to do this because the world needs this. And, this is the new creation. And, passive is not creating anything, that's allocating capital to more of the past than the future, given how quickly we think the future is going to evolve. Passive investing, I would say, it really got going in the 90s, but the tech and telecom bust gave it a big push. And, for years, the world didn't change. For years, the world, the 5 innovation platforms that I'm talking about, sure, the seeds were planted during the 20 years that ended in the tech and telecom bubble. But, we had the transistor, and that was good. But the world wasn't changing so quickly. Now it is changing quickly. And so we're a voice out there, for the new creation. We're here to procreate and to create.
Was there ever a time that you've doubted your faith, or has it always remained paramount in your life?
It's so interesting. I think it's a gift, and I think I was born with a gift.
Yeah.
Now, has it deepened over the years? Absolutely. And certainly tough times, in hindsight, they're not tough when you have perspective. But when you think you're going through tough times and don't have perspective, that's really when it deepens, I think, for most people.
So we got to settle a debate, this is a bit off topic, on Reddit. And there's a photo on Reddit.
Okay.
And 50% of people think this is you. 50% say this is someone else. Is this a young photo of you in college?
Just end the video right here. It's been going on for such a long time.
I would say I can tell, I'm pretty sure this, I don't think this is me because I didn't really wear bangs that much.
I knew it.
That much.
I-
we didn't get exactly, the answer.
But this one is you. This, that might be almost the same photo.
I think that's the same photo.
You have no idea. This has been going on for years. Okay.
Looks more like me, but I didn't wear bangs that often. I did wear bangs when I first moved to New York, I think.
But it's not a resounding yes or no.
It's not a resounding yes. It looks familiar, but that second one, no.
You've settled something that has been going on for the last 4 years online.
Oh, really?
It's
Really?
mostly settled.
It's mostly settled.
Yes, mostly
We could call
settled.
it 90% settled. We're not 100%.
Well, if that's the same
Oh my
person, I
gosh.
know that other one is not. That is not who I am. Just more the angles are different.
That's incredible. Wow.
We did it.
All right, Reddit. You're welcome, guys. You're welcome.
Thank you so much for your time. We really appreciate it. We'll link to all of your information down
Okay.
below in the description as well. This has been a pleasure. We really, really
well,
appreciate it. Thank you so much.
Jack, thanks so much.
Thank you guys so much for watching. We are here in Florida for you guys. So enjoy, and until next time.
Until next time.